By the time the truth came out, the money was already gone. $64 billion. The life savings of families, retirement funds, charities, dreams collected over decades, all dissolved into nothing. Imagine opening a statement every month and seeing the numbers climb, steady, calm, reliable, as if nothing in the world could touch you. Imagine the comfort you'd feel as markets crashed, friends lost their homes, whole banks collapsed, and your balance just kept rising. You'd tell yourself you were safe. You'd tell yourself you were smart. You'd tell yourself you had found someone who knew how to play the game better than anyone else. And then one winter morning, the phone rings, and suddenly the game is over. And you are staring into the kind of silence that feels heavy enough to crush you. The man who promised you safety is sitting in a New York apartment admitting it was all a lie. Not a mistake, not a bad trade, but a lie so big it swallowed everything. That's where our story begins. Not with the fraud, not with the courtroom, but with the people who believed. Tonight, we're going to walk into the quiet offices where the printers hummed all night, where the statements were typed and mailed with surgical precision, where the biggest financial lie in history was assembled piece by piece until it became too perfect to question. And as you listen, ask yourself, how would you know if the story you believe about your money is real? If you find yourself leaning closer to this story, share it with someone who should hear it too, and stay with me until the end. Now, let's begin. He didn't start as a myth. He started as a tradesman, a kid who learned the market's language and then taught others how to speak it. And by the time the 1980s rolled around, he was not just a broker, but a man shaping rules, a visible fixture at NASDAQ, and a voice people trusted when they set policy. Records show he helped shape what some later called the market maker exemption, a change in the rules that let market makers do things others couldn't. Why would that matter later on? Because power writes cover, and cover hides tracks. He built a public life that looked like a ladder to the top. Chairmanships, charity boards, handshakes with senators, mentorships with rising traders who would become names in their own right. Being seen with him became a credential. He kept the trading desk that everyone knew about on floors 18 and 19, bright, public, noisy, and put the advisory business on the 17th floor behind a door few noticed. 2 systems, 2 data worlds. If that sounds deliberate, it was. The front room smelled of polish and new pens. The back room ran on old IBM machines and green screen scripts that could be fed any history you wanted them to tell. How do you teach a computer to show a perfect month? You reverse engineer the number and then make the record match the story. Who checked those records against a clearing venue? Who asked to see contemporaneous executions? For years, the answers were no one, or worse, the auditors who were supposed to check the work with 3 people on a tiny payroll, rubber stamping $50 billion in supposed assets. Does that add up to you? Harry Markopolos did the math and said it didn't. He laid out the statistical impossibilities and the absurd options volume that would have been required to hedge those alleged trades, and he wrote memos and warnings for almost a decade. The SEC touched the file at times. Boston flagged inconsistencies in 2000. New York took notes in 2005. Investigators poked at oddities, and yet the systems that held those dots never connected them. Information lived in silos, and warnings sat in drawers. Meanwhile, feeder funds fed the machine. Reputable names and country club introductions supplied pools of capital that arrived wrapped in trust. People preferred the gatekeeper's word to their own verification. Major banks moved real money through real accounts. Chase processed transfers that, over the decades, totaled in the hundreds of billions. And still, no automated pattern recognition tripped an alarm that said, "Stop and look." How does a claim of steady, unshakable returns survive for decades? Social proof does the heavy lifting. Exclusivity does the rest. When you tell wealthy families you don't take everyone, their envy becomes a partner in your secrecy. He had the polish of legitimacy, board seats, philanthropy, a trading operation that was real enough to hide behind. So when someone asked if the advisory business was trading, the answer was a rehearsed denial and an insistence that everything was above board. The actual mechanics were almost absurd in their simplicity. Pick an outcome you wanted. Run the old tape to create a history that supported it. Backdate entries, fabricate confirmations, and send clients statements that behaved like law. Who created the confirmations? Who signed off on the custodians? Who reconciled the trades to an exchange that showed nothing? The system offered plausible answers that rarely survive scrutiny. When markets shook in 2008, the illusion that had ridden stable inflows finally met a force it could not paper over. Redemption requests came at scale, and the bank account under the advisory business did not contain what the statements promised. If the returns were numbers on paper, where was the execution venue? If the assets were real, where were the counterparties? If fiduciaries existed, why did they not demand ledger-level access? These are not abstract questions. They are the hinge between a tidy file folder and ruined lives. To understand how the public face and private wiring work together, to see how authority was performed so well people stopped asking for proof, we now need to move closer into the room where the fake trades were made, into the green glow of the 17th floor, to the machines and the men who taught them to lie, and to the feeder funds and banks that cleaned the cash long enough for the story to seem true. He was the kind of man who could walk into a room and instantly lower its temperature, not with coldness, but with calm. Bernie Madoff spoke in a steady cadence, never rushed, never flashy, never the type to lean on volume when reassurance was enough. To most people on Wall Street, he wasn't just another trader. He had been chairman of NASDAQ, a pioneer in electronic markets, a man whose very resume made the complicated sound simple. And for private investors, the wealthy families, the foundations, the endowments, he was something even rarer, a guardian of safety. Madoff wore modest watches, sat on charity boards, showed up at galas as the man you trusted to keep your money boring. He built a persona that was part mentor, part caretaker, part quiet genius who didn't need to advertise because his results spoke louder than any pitch. And that was the trick. He never had to sell. People sold themselves on the relief of having someone like him at the helm. But trust is a strange currency. When someone gives it to you, you can either spend it honestly, or you can reinvest it into a story that grows larger than truth. Madoff understood this better than anyone. He cultivated the image of a man too steady to be questioned, too established to be doubted. He didn't need to promise the impossible. He only promised consistency, which felt even more impossible than wild returns. Year after year, His statements looked like a balm against chaos. 1% a month, every month, no matter what the market did. And because he carried himself with the patience of a man who had already won, few wanted to disturb the spell by asking how it all worked. If comfort was the real product, then the numbers were only the wrapping paper. And slowly, the room stopped caring about the math. They cared about the man. Bernie Madoff's power wasn't only in the money he managed. It was in the architecture of the system itself. He had been chairman of NASDAQ in the 1990s, one of the first to champion electronic trading when others still swore by paper tickets and shouts across the floor. He was seen as an innovator, a man who helped modernize the markets. That reputation carried weight not just with investors, but with regulators who often viewed him less as someone to scrutinize and more as someone to consult. At one point, he helped shape what became known as the market maker exemption, the rule that allowed firms like his to sell stock they hadn't borrowed yet, a technical carve-out that gave liquidity to the system but also blurred the edges of transparency. Years later, critics would call it the Madoff exemption, a rule that seemed almost designed for the man who would come to embody hidden leverage. For younger traders, he was a mentor figure. Ken Griffin, who would go on to build Citadel into one of the most powerful hedge funds in the world, once counted Madoff as a guiding influence. The irony is heavy. The man many saw as the safe genius, the teacher of caution and risk control, was quietly building a machine that had no foundation at all. But that's what made him believable. He didn't look like the face of risk, he looked like the cure for it. He knew how to dress the part, how to stay understated. No flashy cars, no reckless bets at the poker table, no desperate need to be seen. He wore quiet suits, kept his gestures small, and always gave the impression that he was protecting people from chaos. His voice carried the authority of someone who had been there first, who knew the rules not because he read them, but because he helped write them. And in the financial world, that is almost sacred. When the person who shaped the system tells you your money is safe inside it, most people stop asking questions. That was the persona. Steady, generous, deeply woven into the fabric of Wall Street and the lives of its wealthiest clients. But behind it, on a single floor, hidden below his legitimate business, the real truth was being written. And in time, the quiet genius would reveal himself as something else entirely. A man who used his credibility not to safeguard the system, but to bend it around his own illusion. Madoff's genius wasn't only that he played the role of market innovator. He also built a social web that made questioning him feel almost indecent. He sat on charity boards, gave generously to hospitals, museums, universities. His name appeared on donor walls beside families that defined New York's elite. When you saw him at a gala surrounded by trustees and philanthropists, he wasn't just a financier, he was a benefactor, the kind of man who seemed to put his success back into the world. That gesture made people feel safe. It built a moral cover that numbers alone could never provide. In the country clubs of Long Island and Palm Beach, his name was spoken with a reverence usually reserved for old money dynasties. Investors whispered about how lucky you had to be to even get in. The exclusivity was part of the theater. This wasn't an open door, it was an invitation. Families told other families that Bernie was the safest hands on Wall Street, and each retelling made the story harder to doubt.
Doubting him meant doubting the judgment of your peers, your neighbors, sometimes your rabbi or priest. Social proof became stronger than math. Even regulators absorbed that aura. He was the man they pointed to as proof that markets could be fair, orderly, and well-managed. A past chairman of NASDAQ, a man who once opened doors for small investors, now cloaked himself in the language of protection. He never flaunted his wealth with gaudy displays. Instead, he presented himself as a steady hand, a statesman of finance. People trusted him not because they verified, but because he made the very act of verification seem unnecessary. That blend of quiet generosity and quiet authority created the perfect disguise. A man who could sit at a charity banquet one night, at a trading conference the next, and in both places project the same careful humility. He had built the character that looked incapable of deceit because everything about him seemed designed to make others feel protected. And in that design was the seed of the greatest financial lie the street had ever seen.
What made Madoff most convincing wasn't just the titles or the charities. It was the restraint. The man who moved billions kept a modest watch on his wrist and wore suits that never shouted. He let others brag about their trades while he leaned back, quiet, almost paternal. At dinners, he listened more than he spoke, nodding with the patience of someone who had seen the storms come and go. People left the table not only convinced he was brilliant, but grateful he had made time for them, as if his calm approval carried more weight than any quarterly report. Younger traders described him as avuncular, a mentor who cared about the next generation of finance. He offered guidance, cautioned against recklessness, reminded them that consistency, not flash, built real wealth. The irony is sharp now, because the very consistency he preached was the product of numbers written after the fact, engineered on old IBM machines one floor below. But in the moment, that consistency was his aura. He gave the impression that he wasn't chasing markets like everyone else, but taming them, bending their chaos into something safe enough to pass down to your children. His lifestyle choices reinforced the story. No tabloid scandals, no champagne-soaked photos, no sudden bursts of extravagance. He lived in quiet wealth, the kind that felt earned rather than flaunted. To investors, that humility was proof. He didn't need to flash because he already had everything. And to neighbors in Palm Beach or New York, that steadiness made him approachable. He seemed less like a Wall Street shark than like the wise uncle at a family gathering, the one who sits at the head of the table and makes everyone else feel calmer just by being there. That was the mask. Quiet modesty, public service, private reassurance. It built an image that made doubt feel absurd. Because how could a man who gave to hospitals, mentored traders, wore the same understated watch year after year, and promised only to protect, how could that man be anything but safe? And so the persona held year after year, reinforced by every board seat, every gala, every quiet dinner where he listened more than he spoke. It wasn't just that he seemed trustworthy. It was that doubting him felt impolite, almost unthinkable. Which is why when the papers began to circulate, the confirmations, the statements, the carefully typed explanations of strategy, they landed on desks already softened by belief. The mask was in place, and the room was ready. Because the truth is, the numbers never came first. The story did. And that's where the lie began to breathe. The lie did not announce itself all at once. It arrived in paper, in the slow rhythm of statements that seemed to echo the calmness of the man who issued them. The strategy he described had a name: split strike conversion, a phrase that sounded technical enough to discourage questions, but simple enough to soothe. Buy blue chip stocks, hedge with options, repeat in steady cadence. No fireworks, no volatility, only quiet consistency. If the market surged, the statements showed gains. If the markets stumbled, the hedge explained the safety. But what mattered most wasn't the math, it was the texture. Each page carried the dot matrix print of trades supposedly executed, numbers that balanced to the penny, symbols that looked familiar to anyone glancing down a Bloomberg screen. And if these returns were real, where did the trades live? The executions never appeared in clearing data, never rippled through volumes where they should have been visible. Yet month after month, the reports appeared on time, like clockwork. On the 17th floor, a small back office with old IBM terminals became the theater where history itself was rewritten. Historical price feeds were pulled apart. Trades were reverse engineered to fit the desired 1% per month return, and then backdated into the system. The trades never touched the market. They lived only on paper. And still, the statements went out. Thick envelopes with names, dates, and balances that investors came to treat as gospel. If every report balanced, why did no one ask to see the execution venue? On the 17th floor of his midtown tower, there was a world apart from the bustle upstairs. Floors 18 and 19 were the legitimate market-making business. Bright, busy, connected to exchanges, full of the noise and hum you'd expect. But one level down, through a door that didn't announce itself, the air changed. The carpet muffled footsteps. The lights were softer, and the IBM AS400 terminals glowed with a green that belonged to another decade. Here, a small staff worked in silence, feeding historical price data into old machines, then bending that data until it matched whatever return Bernie had promised. Reverse engineering trades after the fact, they built portfolios that never existed, then backdated them to look like they had been placed in real time. The choreography was tight. Every statement formatted to perfection. Every trade confirmation stamped with the right codes. Every envelope folded and mailed without delay. No one outside that floor ever saw an actual execution ticket. If every line of paper referenced another line of paper, where did the circle begin? Upstairs, phones rang and deals moved. Downstairs, numbers were written into being. Two businesses in one building. Separate staff, separate systems, separate truths. And the investigators who eventually walked those halls never thought to connect them. They never even asked to see real trading records. They asked a man if he was running a Ponzi scheme. He said no. Case closed. The 17th floor was not a trading floor at all. It was a workshop of paper. A theater where numbers were rehearsed until they looked alive. The staff inside weren't brokers shouting into phones or traders glued to screens. They were clerks, typists, loyalists who followed instructions with precision. They pulled data from old feeds, adjusted it like clay, and backfilled trades so perfectly timed that no one thought to question them. Every page was proof of a market that had never existed, yet the rhythm of its production made it feel inevitable. Printers hummed late into the night, spitting out confirmations and statements with dot matrix edges, pages that were cut, collated, and sealed in envelopes stacked by the door, a ritual as steady as the returns themselves. Upstairs, orders were real, stock moving, clients shouting, phones buzzing with urgency. Down here, silence. Only the glow of terminals, the scrape of a chair, the faint rattle of envelopes sliding into bins. No ticker noise, no market chaos, only the illusion of control. And this silence, the absence of proof, was the very thing that made it work. If everyone trusted the paper, who bothered to ask about the trade?
They weren't glamorous, and they weren't known outside that floor, but they were essential. The aides, the clerks, the quiet operators who turned Madoff's instructions into ritual. Some had been with him for decades, loyal to the point of blindness. They arrived early, left late, and kept to their tasks without question. One handled the incoming checks, logging deposits in ledgers that never touched the real trading system. Another prepared the outgoing statements, aligning columns of numbers so neatly they could pass any casual inspection. A few managed the IBM terminals, pulling market data and backfilling trades until every fake order matched the day's history with surgical precision. Their movements were small but rehearsed. The way they folded envelopes, the way they stacked piles on a desk, just so. The way they passed papers hand to hand without a word. To an outsider, it might look dull, clerical, but it was choreography. Every gesture reinforcing the illusion that the money was alive, that trades had been placed, that wealth was growing. And because they were ordinary, because they looked like nothing more than diligent staff at their posts, the deception became harder to see. If the deputies looked real, what made them believable? Title, posture, or simply the weight of paper in their hands?
They asked a man if he was running a Ponzi scheme. He said no. Case closed. And that somehow was enough. What's harder to grasp is why it felt enough for so many for so long. Investors, banks, even regulators found comfort not in proof, but in the rhythm of numbers that always arrived on time. Month after month, through crashes and rallies, through panic and euphoria, Madoff's returns never broke stride. A neat 1%. Not too high to spark suspicion, not too low to disappoint. Just enough to feel safe. And safety, in the markets, is the rarest drug of all. The trick wasn't in dazzling people with riches. It was in lulling them into quiet certainty. To be let in on Madoff's fund was to be part of an exclusive circle, a whispered club within country clubs and charity galas, where the promise wasn't extraordinary wealth, but the steady hum of protection. And once you were inside, the last thing you wanted was to question the walls. The statements looked official. The paper felt heavy. The aura of exclusivity wrapped the lie in a warm blanket of trust. And when the world outside, the 17th floor, spun in chaos, that paper seemed to hold still, as if chaos itself had been outsmarted. It wasn't just money that was being printed, it was reassurance. And reassurance is what blinded even the sharpest eyes.
He didn't need to shout his brilliance, because the room carried it for him. At charity boards, he was the quiet presence who spoke last. His opinion offered with the weight of someone who had already solved the problem. At country clubs, his name was whispered like a password, not as a salesman's pitch, but as a secret only certain families deserved to know. Exclusivity did half the work. "We don't take everyone" sounded less like a filter and more like protection, a velvet rope that made those inside feel safer precisely because others were left outside. Feeder funds amplified the theater. Many investors never wrote a check to him at all. They wired money to Fairfield, Tremont, or Ascot, and those firms passed it along. It meant you could sit across from your manager, ask if they'd done the due diligence, and receive an easy nod. The circle of trust was complete. The client trusted the manager trusted Madoff, and Madoff trusted no one but the silence of the 17th floor. Even his personal image reinforced the illusion. He wore modest watches, not flashy trophies. His suits were tailored, but never loud. He smiled in photographs like a man who understood your fear and promised to carry it for you. The aura was avuncular, almost paternal, a mentor who would tell you that markets were dangerous for others, but not for you, not if your money was with him. And once that belief took root, the numbers no longer needed to prove themselves. They simply arrived, month after month, like the weather.
Behind the polished reputation and the soft voice was a machine that never touched the markets it claimed to master. On the 17th floor, tucked away from the legitimate trading desks upstairs, stood rows of IBM computers and dot matrix printers humming like ghosts from another era. The strategy was called split-strike conversion, a mouthful that sounded sophisticated but simple enough to soothe wealthy clients. Buy a basket of blue-chip stocks, hedge the downside with put options, tap the upside with calls. On paper, it was plausible, the kind of approach you'd expect from a cautious genius promising steady gains. But no trades were ever placed. Instead, Madoff's small team would look backward. They pulled historical market data, ran it through those IBM terminals, and then reverse-engineered trades that would have produced exactly the return they wanted, usually 1% a month, smooth, consistent, too perfect for reality. The printers would then spit out fake confirmations, complete with CUSIP numbers, timestamps, and the grainy texture of authenticity. These reports would be bound and mailed like clockwork, proof delivered right on schedule. For clients and feeder funds, the paper was the market. Nobody checked whether the volumes lined up with real activity on the exchange floors. Nobody asked where the executions took place. The aura of exclusivity and the steady arrival of those statements did all the work. In a business where most people beg for volatility to calm down, here was a man who had tamed it completely, at least in ink. The silence of that room The rhythm of those machines and the trust of thousands of investors combined to build an illusion stronger than fact.
They picked a target return, usually a steady 1% a month, then worked backward, pull historical prices, calculate the exact trades that would have produced that return, and encode those trades into internal blotters. Those blotters never hit an exchange. They were entries in a closed system on AS400s. Next step, fabricate the confirmations, CUSIP numbers, settlement dates, counterparties, timestamps, and print them on dot matrix paper so they looked like authentic execution records. Backdate everything to make the timeline line up. Update ledger entries and client account balances so monthly statements reconciled to the penny. Mail the statements on schedule so the external rhythm matched the internal fiction. When withdrawals arrived, use the firm's chase account and incoming flows from feeder funds to pay redemptions, rob Peter to pay Paul, until cash ran wry. Auditors were tiny, compliance checks superficial, and no one demanded exchange-level clearing records that would have exposed the absence of real executions. Markopolis later showed the math. The options volume and trade footprints required by those reported positions didn't exist in the market. The entire scheme was therefore a sequence of deterministic steps: target return, reverse-engineered trades, fabricate confirmations, backdate and reconcile, print and mail statements, recycle cash for redemptions, a paperwork algorithm that only failed when the cash flows it depended on stopped. They were not celebrities. They were the steady hands that turned instruction into paperwork and paperwork into plausibility. Frank DePascali ran the advisory desk, the man who knew the fiction and managed its day-to-day choreography. Annette Bongiorno and Joan Krupi were the clerks who formatted statements and created the confirmations that looked lived in. Numbers aligned, dates backfilled, signatures that matched templates. David Freeling was the outside accountant whose rubber stamp of approval made spreadsheets feel audited, even when real verification never happened. Peter Madoff, the brother in compliance, and a handful of long-time assistants kept access narrow and habits consistent. Family ties and staff loyalty reduced friction and discouraged curiosity. Each role had its ritual. One person pulled historical price feeds and fed them into the AS400s. Another copied the fake execution lines into client blotters. Someone else printed the confirmations on dot matrix paper so the texture felt right. The outgoing envelopes were checked twice, stamped, and stacked where couriers expected them. Who drafted the comfort letters that soothed trustees? Who signed the short emails that read like routine updates? The answers are in indictments and plea allocutions. People who struck the pose of normalcy while executing a script written to deceive. They worked in shifts, quietly and efficiently, and their ordinary gestures, folding, stamping, filing, became the choreography of a lie. If the deputy looked real, what made the deputy believable? Title, posture, or paper in hand? If a comfort letter arrived with the right letterhead, who bothered to call the supposed guarantor? These were not brilliant conspirators at every turn. They were craftsmen of routine, and routine is what normal people trust. The conspiracy's genius was not flair. It was repetition, division of labor, and the quiet elimination of routes to independent verification. Next, we move into the theater where those documents met clients in person, the meetings, the cards, the stagecraft that turned a folded sheet into faith.
They didn't meet in dark alleys or smoky back rooms. They met in places that felt safe, ordinary, even aspirational. Neutral conference rooms in Midtown, country club dining halls, charity banquets where the lights were soft and the introductions came with a smile.
A polished mahogany table does half the work if the right names are seated around it. The air smelled faintly of citrus from the staff polishing before guests arrived. Glasses set neatly, business cards stacked like tokens of legitimacy. Madoff rarely sold anything directly. He didn't need to. A card handed across the table with Chairman Nasdaq already carried the weight of proof. A nod from a feeder fund manager, a whispered endorsement from a fellow trustee at a museum. Those were the signatures that mattered more than ink. He didn't pitch performance. He embodied reliability. The ritual was simple: a brief conversation about markets, a mention of consistency, the quiet assurance that not everyone was invited in. The exclusivity made the room feel smaller, tighter, more privileged. No one demanded trade blotters when they were given access to what felt like a secret. The table, the titles, the timing of introductions, all of it acted as stagecraft, a theater that whispered, "You're safe here." If the room felt normal, why did no one notice that the only thing remembered clearly afterward was the card, the smile, and the sense of belonging? The performance was so smooth that the absence of proof became invisible, and the meetings themselves became the guarantee. It always started small, a first wire that didn't feel like risk at all. $1 million here, $5 million there. Numbers that sounded large but looked ordinary when stacked against the reputations in the room. The instructions were typed on familiar forms. The reference lines carried standard phrases: custody transfer, equity allocation, the kind of language that never draws a second glance. On the receiving end, the Chase account reflected the deposit. The balances reconciled, the statements matched. A screen lit up with green confirmation, and that glow was enough to calm even the most cautious client. No alarms, no red flags, no mismatched entries. The money seemed to land exactly where it was supposed to. What no one saw was how carefully the amounts were calibrated, just below the thresholds that might trigger deeper oversight, just within the limits of what looked routine. It felt like weather, like the normal movement of funds across the system, and weather doesn't get questioned. The trust was reinforced not with explanations, but with consistency. The first wire cleared, the statement followed, and life moved on. Each small step taught investors the same lesson: everything is fine, everything balances, everything works. If the first step looked like weather, who decided when it became a storm? The storm was already building, but in that moment, it felt like nothing more than another quiet day in the market. They called it the split-strike conversion, a phrase that sounded technical enough to reassure without inviting too many questions. On paper, it was an option strategy: buy a basket of blue-chip stocks, sell calls to generate income, hedge with protective puts. A formula that could, in theory, deliver steady returns while smoothing out market storms. But what Madoff sold was never the strategy itself. It was the feeling of safety wrapped in complexity. Clients saw summaries with crisp cover memos, position lists that referenced real companies, and diagrams that suggested hedging discipline. It all looked plausible, even elegant. What no one noticed was that the trades themselves never appeared in the real market. There were no footprints on the exchanges, no volume spikes to match the billions supposedly moving. Instead, the trades were generated after the fact. His team would pull historical prices, feed them into the old IBM AS400 system, and reverse engineer which transactions would have created the smooth 1% monthly return he'd already promised.
The statements were printed on dot matrix machines, so the paper felt authentic, the ink a little uneven, the texture familiar to anyone used to confirmations from a real broker. Even the timestamps were backfilled, so the trades looked as if they had cleared in sequence, just like real execution tickets. It was choreography, numbers chosen not for risk management, but for narrative consistency. A client would open an envelope, scan the line items, see that the names were familiar, AT&T, IBM, Coca-Cola, and feel the quiet relief that their money was working exactly as promised. If the trades were perfect, why didn't the market ever show them? If every report balanced, why did no one ask to see the execution venue? Familiarity became its own disguise, and the comfort of paperwork was enough to make the impossible feel routine.
The lie never stayed confined to one room. It spread through feeder funds, institutions that acted as middlemen, promising their clients access to something rare. Fairfield Greenwich, Tremont, Ascot. The names carried their own prestige, and when they vouched for Madoff, it sounded like a second layer of due diligence. In reality, the funds collected their fees, filed their updates, and passed the money along. Investors often didn't even know their wealth had been funneled to Madoff. They thought they were investing with Fairfield or Tremont, not a man running a secret on the 17th floor. Every delay was dressed up as professionalism. A status memo here, a polite letter there. Sometimes a new summary of positions that looked timely and precise. If withdrawals took longer than expected, the explanation came wrapped in industry jargon about settlement cycles or market timing. And if patience wore thin, another document would arrive. A statement, a confirmation, a letter that reset the clock on suspicion. The commissions, whispered behind closed doors, added their own lubricant. Not outrageous, not loud, just flattering enough to keep gatekeepers satisfied. Routine itself became the greatest disguise. Statements arrived on schedule, balances updated with mechanical consistency. The returns never spiked high enough to draw suspicion, never dipped low enough to create panic, always hovering in that narrow band that felt safe. Familiarity hardened into belief. Clients stopped asking. Intermediaries stopped pressing. The machinery kept moving, not because it was flawless, but because it was steady, polite, and on time. If the guarantees comforted everyone, who guaranteed the guarantees? If the timetable kept moving forward, why did the ground never move at all? The escalation was never about dazzling anyone. It was about teaching them to accept the rhythm of the lie as the rhythm of the market.
It was December 2008, and the world was already bleeding. The financial crisis had gutted banks, pensions, and ordinary families. Markets were down almost 40%. Investors everywhere were desperate to pull cash out, to save what little remained. They turned to the one man who always seemed untouched by the storm, Bernie Madoff. His fund had never faltered. Month after month, year after year, he promised steady gains. But this time, when investors asked for their money, the illusion cracked. They requested $1.5 billion. In Madoff's accounts, there was barely $300 million. For the first time in decades, the magician's hat was empty, and he knew it. On December 10th, inside his Upper East Side apartment, Bernie Madoff told his two sons the truth. He called his empire what it really was, one big lie. He admitted he had nothing left, no secret strategy, no trades, just a giant hole where billions should have been. His sons sat in silence, listening to their father confess that his life's work was nothing but a fraud. They left that apartment and called their lawyer. The next morning, the FBI knocked on Madoff's door. He answered wearing a simple blue sweater, as if it was just another day in Manhattan. But when the agents placed him under arrest on December 11, 2008, the facade finally collapsed. In that moment, the man who had once been the chairman of Nasdaq, the quiet king of exclusivity, the trusted steward of fortunes, was revealed as the architect of the largest Ponzi scheme in history. For decades, he had fooled regulators, banks, billionaires, and charities alike. But now, with handcuffs on his wrists and the cameras waiting outside, there was no hiding. The lie had consumed itself.
3 months after his arrest, Bernie Madoff stood before Judge Denny Chin in a Manhattan courtroom. He was 70 years old, wearing a plain dark suit, his once carefully managed image reduced to the posture of an old man waiting for judgment. The room was packed with victims, teachers, retirees, charities, foundations, all people who had trusted him, many of them clutching letters, photographs, or trembling notes of testimony. When the judge asked for his plea, Madoff didn't fight. He admitted everything. 11 federal felonies, securities fraud, mail fraud, wire fraud, money laundering, perjury, false filings, theft from pension plans. For years he had smiled as he stole. Now he stood silent as his crimes were read aloud. The prosecutors asked for the maximum, 150 years. Judge Chin agreed. He called the fraud extraordinarily evil and unprecedented. The courtroom heard the sentence that no one believed they'd live to see. A man who had ruled Wall Street, who had mentored executives and dined with senators, would die in prison. Madoff didn't flinch. He offered a short apology, admitting his legacy was shame. But even in that moment, many victims felt no remorse from him, only resignation. And so, in June 2009, Bernie Madoff was led away in handcuffs once again, this time not back to a penthouse, but to a federal prison cell. The man who once moved billions with a phone call was now reduced to an inmate number, sentenced to a life that would end behind bars.
Prison stripped Bernie Madoff of everything except time. He was sent to Butner Federal Correctional Complex in North Carolina, a place known for housing white-collar criminals and aging convicts. Inside, he was just another number, 617-27054. The man who once dined at Palm Beach country clubs now lined up for bland meals, shuffled through corridors in a khaki uniform, and answered to guards half his age. At first, some inmates treated him like royalty. They called him Uncle Bernie. Others saw him as prey, a man whose name carried infamy but no power here. He got into fights. He grew frail. His health broke down.
As the years passed, the empire that had shielded him crumbled from the outside. His wife Ruth retreated into obscurity, living on the scraps left after forfeiting nearly everything. His sons did not survive the shadow. Mark took his own life 2 years to the day after his father's arrest, and Andrew died of lymphoma in 2014. The family name was now a curse, and Bernie, sitting in a prison medical unit, lived long enough to watch the ruin unfold. In 2020, with kidney failure and a failing heart, he asked for compassionate release, claiming he had less than 18 months to live. The request was denied. The crimes were too vast, the damage too deep. On April 14, 2021, Bernie Madoff died in that prison hospital at age 82. His ashes went unclaimed by his family, left sitting in a lawyer's office. The man who once controlled $65 billion died with nothing. No wealth, no legacy, no honor. Just the memory of the biggest lie Wall Street ever told.
Bernie Madoff's death didn't end his story. It forced us to confront the uncomfortable truth behind it. Because the real lesson here isn't just that one man engineered a fraud so vast it swallowed billions. It's that he was able to do it in plain sight for decades, while institutions that should have stopped him chose convenience over courage. The SEC had reports, warnings, even mathematical proof handed to them, and they looked away. Banks processed billions in transfers that defied reason, and they stayed silent. Feeder funds funneled pension savings, charities, and ordinary retirements into his hands without asking the questions that might have saved lives. What makes Madoff's crime terrifying is not its complexity, but its simplicity. Fake records, old IBM computers, a monthly promise of steady returns. That's all it took. And yet the world believed him because he looked the part. Calm, avuncular, modest, respectable. He wasn't a wolf hiding in the shadows. He was a shepherd in the open field, smiling as the flock followed. The ripple effects remain almost impossible to measure. Thousands of victims lost everything. Generational wealth evaporated. Charities collapsed. Dreams were erased. Some never recovered. Others never forgave themselves for trusting him. And perhaps the most haunting cost of all, his own family shattered under the weight of his deception. 2 sons gone, a wife condemned to loneliness, a name that will forever stand for betrayal. So what do we do with this story now? We remember that trust is fragile and appearances are cheap. We remember that oversight means nothing if it bows to power and reputation. We remember that anyone, no matter how polished, how generous, how established, can build their empire on lies. And we remember that silence is complicity, that every regulator, banker, and fund manager who ignored the warning signs helped the scheme live longer than it ever should have. Bernie Madoff wanted to be remembered as a financial genius. Instead, his legacy is a cautionary tale etched into the bones of Wall Street, a reminder that fraud thrives not because of brilliance, but because of willful blindness.
It teaches us that the most dangerous lie isn't the one told. It's the one everyone agrees to believe. And that's why we tell this story, not to relive the scandal, but to understand how it happened and how easily it could happen again. Because the shadows of history are full of people like Madoff, people who knew that the right smile, the right story, and the right silence could let them get away with anything. If this story resonated with you, share it with someone who should hear it too. Subscribe so you don't miss the next hidden chapter we uncover. And remember, every empire built on lies eventually crumbles. The only question is, how many lives it destroys before it falls. Now, the shadows close on Bernie Madoff, but they will open again soon. Stay with me. The next story is waiting.